In everybody. Good to see you. My name is Ellis Hammond, Vice President of Capital here at Aspen Funds, and excited to jump into this webinar on the difference between debt versus private credit. And this is live, so I'm looking forward to this will be about a 30-minute presentation that we'll have a chance to really ask questions. The reason I did this webinar is we are coming up to the end of the year, and we are getting, we have several two income focused funds, one debt, one private credit. Even the term private credit, is, I would say, fairly relatively trending. I would say newer. Debt has always been around. Private credit is more of an emerging asset class. BlackRock, and others predict this to be close to a $3 to $4 trillion asset class by 2020 or by 2030. And so I think, even just the language can sometimes be confusing. And so we get a lot of investors asking, hey, which one should I be in? What's best for my portfolio? How are each taxed? Which I know is top of mind for a lot of people. And so you're looking to, figure out ways to generate predictable, stable income outside of the stock market, but you want to do that in an efficient manner. So if that's you today, I'm excited to be here with you. If that is you, if that's what you're looking for, put me. I would love to hear from you. And we are going to jump in. Again, this is live, and so I look forward to answering a lot of your questions today. So here's where I want to start. Feel free to type here in the chat. I can see everyone. Hello. Let me just say hello. All right, here we go. Okay, so I want to bring this up to stage, and this is going to be very kind of interactive, and I'm a better typer than I am writer, so I'm going to type most things today than write. But this is something I always start with when we're talking about debt, private credit, etc., because I think it's such a great visual for understanding the essence of a deal and kind of where you sit as an investor. And so this is the capital stack, right? This is pretty consistent across all assets, right? Rather that be real estate, rather that be business, etc. And as you know, when you think lower in the capital stack, typically the first money is debt, right? This is senior debt. This is first position secured debt, meaning you are the first to, if you are the senior debt. So in most cases in a real estate transaction, this is likely the bank, right? Or this is an agency type debt. And this is the first person to get paid back, right? So you are typically the first to get paid. You're lower in the capital stack. But what does that mean? That also means it's typically the lowest return. Why? Well, you're taking the least amount of risk in order to go get that yield. And so risk and return they work together, of course. And so the lower you're in the capital stack, you should expect lower returns. Now, is that bad? Of course not, right? Should everything in your portfolio be going for double-digit, triple-digit returns? Absolutely not. This is a great place to be with some of your portfolio. You're taking less risk. You're getting more predictable income. I would say lower in the stack, it's more predictable. It's lower. But then guess what happens? The higher we go in the capital stack, which is we're introducing more risk, it also means higher returns. And so when we talk about debt, there's two types of debt. There's senior debt and there's mezzanine debt. And just think about mezzanine debt as like second position, right? Meaning it is it is money to be paid after the senior. Typically, the senior has to approve there to be mezzanine, and they have to work together. What I want to kind of share with you today is when we talk about private credit can still be, there's a lot of different things when we talk about private credit. I was just at a conference this week with, some of the largest pension funds in the state of Texas, and these are guys investing in kind of upper middle market assets. So when they talk about private credit, I mean, think about BlackRock, and they're doing big things in business. And so they could still be doing senior debt, mezzanine debt. But I want to stay true to Aspen today because I don't want to get so, open this box too wide. So when we talk about private credit, really what we're talking about is kind of the two things in this red box: preferred equity and mezzanine debt. And most of what we're doing is pref equity. Now, pref equity is not a debt position. This is actually an equity position. But in most cases, we can have, how do I say this, bank-like terms, right? That's the nice thing about pref equity. Now, you're typically behind the senior, so the senior has to get paid. But with preferred equity, you typically can have bank-like terms, assuming that the senior approves this, meaning we can have functions in the operating agreement that allow us, if the if the borrower defaults, we can do things like drag to market, which means we can force them to sell. We can take over, right? We have takeover rights, or we can replace a manager. And so this is the nice thing about being in preferred equity. And then the last space, of course, is common equity. And if you've invested in multifamily deals in the last 5-10 years, as an LP, this is probably what you've invested in, or any other type of real estate or syndication deal, you've probably invested as common equity. Now, that's not a bad thing either. You were probably going for higher returns. And again, the last to get paid is typically the highest return. The reason I think this is so helpful and so helpful to start with as a base is I think most investors over the last 5 years, if you're new to alternative investments, if you're new to the world of syndication, you've done a lot of common equity positions. And maybe you've thought in the past, hey, I'm well diversified because I'm in multifamily, or I'm in self-storage, or I'm in different things. But a lot of the conversations I have with investors is most of their LP positions are in this common equity block, which means you may be well diversified from an asset class, but you are not well diversified from the capital stack. And this is so, so important, and honestly becomes way more important the closer you get to retirement. Because if most of your deals are in the common equity or last position to get paid, you're taking significantly amount more risk than you are as you go lower in the capital stack. And so what I want to just open your mind to today is really ask yourself the question, hey, where am I in the stage of life? Do I need to be taking, or maybe in my public portfolio versus private portfolio, or maybe all of my private portfolio, where am I on the capital stack? And do I need to begin to shift things around, or maybe just invest more lower in the capital stack? If you're maybe a younger investor and you're all in debt, maybe it's time to go in more common equity positions. Does that make sense? Give me a thumbs up or a yes if this is just, I want to make sure this is making sense for people. And again, I'm happy to take questions here in just a little bit, but I want to make sure this is such an important concept for folks to get, of where you sit in the capital stack. I'm curious. Thanks everybody. Yeah, I see a lot of yeses. Where is most of your portfolio today? Is it common? Is it senior? Is it somewhere in the middle? Say top, middle, or low. Top, middle, bottom. Where is most of your stuff at today? Top, middle, or bottom? Top, middle, or bottom? Why don't you post and let me know kind of where you're at? Matt says down at the bottom. Okay, good. Milton says more at the top. Great. So Barry says at the top. So good. So yeah, there's a good mix, and that's no surprise here that we have investors. Yeah, a lot of people in the top. Again, this is where a lot of people are, especially over the last 5 years. Is there were attractive returns to go get. Now we've also seen though that just because you were promised top returns, how many people have experienced this? You were common equity going after 15 to 20%, returns, and you didn't get that at all. Or maybe you lost money, right? Because you weren't the senior debt, and, market shifted, cap rates expanded, interest rates exploded, and now you're not getting paid at all. Or, your dividends have paused completely. I can assure you this, if your dividends pause completely, guess who's still getting paid? The senior, right? Now, again, none of these are evil or bad. It's just helpful to know where you are at and where you want to be as you build and grow your portfolio to be well diversified. Right. So I want to just show you a couple things. So here's what I'm going to do today is I want to talk about the difference for us between our two funds, Aspen Income, which is primarily our debt fund. Okay. And our Aspen Private Credit Fund, which is, of course, our private credit fund. So I want to kind of just go through 3 different things. I want to talk about, and again, this is, as I'm doing this so you understand our two funds primarily because you came from our investor club or our email list, but I also think this is going to be helpful. You can assess as you're looking at other debt and other private credit funds as well, what questions to ask. Okay. And so if you're vetting between our two funds, great. If you're going to vet other funds, this will be helpful just to kind of know what questions to ask and what to look for in each of these funds. So I hope this is both educational from an investor standpoint of Aspen or potential investor standpoint of Aspen, but also as you're looking at other funds as well. I want this to be helpful for you. So let's just talk about assets from the Aspen Income Fund. So I have our partner letter pulled up from Aspen Income. So Aspen Income today holds a total of 955 loans. 172 of those are first lien position notes, and the other 783 are second position notes. Everybody can see this okay? Let me know if I need to do anything different. I can make this a little bit bigger as well if I need to. Okay. So this is, this fund, this is significant, right? And this is why I'll kind of get into different things, but this is 955 loans, 100. This is mostly hard money. And these 783 second position loans are all residential mortgages, second position performing notes. I'll give you a couple. I'm really glad I didn't decide to write all this today. It gets really ugly when that happens. Okay, so a couple things I want to share with you. This fund's been around for a long time. This is our longest standing fund. The overall LTV. So this is really important when you think about LTV, or loan to value, right? This stands for loan to value. This essentially just helps you understand how much equity cushion, right? You want to know what this is, because this is asking the question, how much equity cushion do we have, right? So in our second position notes, we have 55.5% LTV on this. And so that means we have about a 45.5% equity cushion on the largest percentage of the portfolio. And in second, you say, oh, second position notes, like is that risky? What is that? I mean, again, like the default rate on this is very, very low. In fact, let me see if I have this in the partner letter. I mean, this fund's been around for over 12 years. So in Q3 during the quarter, let's say we worked with our borrowers that were behind. We secured 125 full reinstatement. So this is where the borrower fully catches up on past due payments, and 21 partial reinstatements. The nice thing, we also, the fund exited 42 notes during that quarter as well. And so again, the default rate on this is very, very small. I mean, think about it from a just a practical standpoint. If you're living in a home, most people want to pay their mortgages. Most people want to pay their rent. I know we see headlines of other things happening in states like California and New York, but for the majority of people, they want to pay their rent. They want to pay their mortgage. Why? Because they want a place to live, right? And so this is across all 50 states in this one. Now, from the second position stuff, I do have that LTV here. The LTV on the first lien position is right around 50 to 65% LTV. Okay, so you can see that this has really strong equity cushion. So this is really important to know. If you're going to be in a debt position, how much, just because you're the first, again, going back to this, just because you're the first position here, question is, well, how much, like how levered are you, right? And so, typically something around, below 70% is considered, pretty good equity cushion. But again, the lower, in my opinion, if you could still get the yield, the better. Okay, let's talk about assets over here in the private credit. So in private credit, what we are doing is pref equity and mezz placements in CRE assets. So today we have about 12 placements, what we'd like to call them. And these are across multiple asset classes. So this is all CRE, or all commercial real estate assets. In fact, I don't think I have this. Can't really. I think I can do this. Can you guys see this okay? Yeah, you can. So this is really cool. This is in our data room, but you can see all of the different commercial real estate assets we have in this fund today, where everything is located. So it's pretty, geographically diverse. You can also see all the different asset classes. So we have a lot of multifamily, we have some industrial, there's some student housing, there's some medical office. You can also see the use case in terms of our funds, how much percentage of our funds went to just acquisition help, how much went to recapitalization and how much of a percentage went to development. And this is essentially the breakdown of this portfolio. And then you can see over here is about 12 deals, right at 40 million deployed today. And then these are really important metrics to look at when you're going to be in a pref equity, in our case, private or credit preferred equity position. Is what is the LTV? So at a current LTV, the weighted average across all loans is 82%. And then on a stabilized value, meaning this is where the value is going to be once these properties are stabilized, is right at 70% in a weighted stabilized DSCR at 1.3. Again, this is another important metric as you're looking at debt and credit instruments. DSCR is a health metric. What that means is how many dollars of net operating income do you have for every dollar of debt? And so that just means like, can you pay, do you have more money coming in than you have debt payments going out? And so this is a very healthy metric that you want to ask or want to look for in any real estate deal, right? What is the DSCR? And so here, from a stabilized standpoint, this is very healthy, 1.33. Typically, like an agency loan, they're going to require on acquisition somewhere between a 1.1 to 1.25 DSCR. And so that should give you some type of benchmark of what to look for. I mean, one is, of course, break even, right? So anything above one, you're bringing in more net profit than you are debt going out. Okay. All right. Let's switch back here. Now that we understand the assets in both of these different funds, this is a question we get a lot. Okay, so what about taxes? So in the Aspen income, and this is where I feel like things really start to, I would say, separate for people. So if you're saying, okay, where should I be at in 2025, 2026, if I'm making decisions, which one do I want to be in? So Aspen income, we'll just kind of start on the left and we'll go over to the right. Again, remember, this is AI and this is APCF. Okay, so everything that comes, since this is debt, everything is going to be earned interest income, which means that everything is going to get taxed at your effective tax rate today. So if you're in a higher tax bracket, this is where you're going to get taxed at. Earned interest income, effective tax rate. If you're going to be doing, some type of debt, this is essentially always what is going to be the case. In most debt funds, you are going to get a 1099 INT for your tax purposes. In Aspen income, however, we actually issue a K1 because just the way that we've structured it from a partnership standpoint. So you do actually get a K1. So the nice thing is that this income is treated passively. So that is the difference here. Because you're getting a K1, the income is treated passively, which means if you have other depreciation, let's say from a multifamily deal that you've done and done cost segregation, bonus depreciation, et cetera, you can use other depreciation to offset the income. Okay, so that is with other depreciation, or we'd say outside depreciation, to offset the income from this fund. And so that is really helpful. The other thing I know a lot of people are going to ask me is, what about UBTI? And this is typically significant for IRA accounts. I also learned the other day that anything above $12,500, I don't know if you guys know this, it's kind of wild, $12,500 is taxed at the highest rate. So I realize why people are conscious of this. This matters, right? Because it doesn't take much to be taxed at the highest rate. Thankfully, in 12 years, no UBTI in this fund. Okay, so really not an issue for folks who are considering this. Okay, I'm gonna bounce back over here. Sorry, there's a lot of questions and I'm kind of looking at my screen. So good. Let's be considered mezz. Yes, second position notes would be considered mezz. And yes, both of these funds are open, by the way. Okay, both of these funds are open. So let's talk about taxes for APCF. Okay, so remember, this is pref equity primarily, and pref equity, little mezz. Okay, so we have maybe one or two mezz positions and primarily pref equity positions. This can grow over time, but really where we're seeing opportunity and where we're seeing yield is in providing pref equity to sponsors for acquisitions. And so because of this, because this is pref equity, primarily pref equity, most of the income that comes in the private credit fund is actually rental income because of the pref equity. Okay. So this is actually rental income. There is, like I said, if because this is pretty small in the portfolio today, this would also, if the income we do get from the mezz positions is earned interest income, just like we do over here at AI, but it's a really small percentage. It's really, I just want to talk about kind of the main overarching income that you're experiencing from this fund, which is rental income. And so again, this is also taxed at your effective tax rate. So if you're in a high tax bracket, this is going to get taxed. I mean, here's the thing with income, guys, and I'll show ways. We're going to talk about ways to make this more efficient and offset some of this. But the reality is, like, if you're making income, you're going to get taxed on it, regardless. Now, are there ways to make that income more efficient? Absolutely, right? And so we'll talk about that here in a minute. But in a lot of ways, like if you're making income, you're going to have to pay taxes on it, and that is the reality. Now, are there ways to help offset that? Of course. But, in the grand scheme of things, when you make money, you pay taxes on it. So because this is also a K1 investment. And so that means all income is treated passively. The nice thing about being in primarily pref equity positions is because we have pref equity positions, we also are able to pass through depreciation. And so this fund, unlike Aspen Income, we can use that depreciation to offset the income. So in the short run, and maybe even in the long run, this is a much more tax efficient vehicle for cash investors. Okay. Because, for example, last year, the realized yield on this fund was right at 10.5%. On the K1, we showed a 20% loss on invested principal. So that means if you put in $100,000, you made, $10,500. Well, on the K1, you actually showed a 20% loss on your invested capital. That's a pretty big deal, right? You really can't do that in a typical debt type fund, but because we're doing pref equity positions, you're able to do that. And so it's very, very efficient for someone who is investing via cash. Now, the one thing to remember when you're using depreciation is there is recapture. And I've learned that personally in 2025, that if you use the depreciation and you sell the asset, guess what happens? You have to pay it back, essentially. It is much more like a loan than it is a gift. The government is giving you this depreciation because, you're doing valuable stuff for the economy, but they expect it back. And so this is nice because it allows you to, increase your returns in the short run. But in the long run, you need to be aware that if you exit this fund, and over time, that the fund itself is going to experience recapture, and kind of that nets out in the NAV, or the net asset value of the share price. But when you exit this fund, there is some recapture that gets treated in this as well. Now, the thing we haven't talked about for both of these funds is I guess we talked about IRAs for UBTI. For this, let me talk about UBTI on this one as well before we get into IRAs. So UBTI for this fund has not been around as long. So this is a 2-year fund, 24 and 25. No UBIT. Okay. It is possible in private credit, in our private credit fund, that there could be UBIT in the future. And so if you are considering investing in a qualified account, IRA, 401k, et cetera, that there could be UBTI. We are likely going to implement a blocker. We can, there are ways to prohibit that from happening by, putting in a blocker into the fund. And so it's likely that if we begin to experience that, or expect to experience that in future years, that we will put a blocker into this fund, so that and we would just essentially convert the IRAs into that different structure. And so again, I wouldn't let this stop you if you're considering investing with an IRA. Now, the thing about an IRA, or if you invest in IRA 401k, the depreciation stuff doesn't matter, right? Because you don't get to use any of it. And so that is one thing to consider, when you're investing in IRA, self-directed IRA. If there are, depreciation pass-through or benefits from that standpoint, some ways you're just kind of saying, hey, that I'm not going to use that, right? And so it really doesn't matter for you in that regard. Okay, let me see if there's anything else here I want to talk about. Let me see if there's any questions about this so far. Yeah, so UBTI is it's funny. I was just actually kind of walking through this earlier with an investor. So UBTI is what we call unrelated business taxable income. Okay. And so it's a kind of a broad category of income generated by tax exempt entities such as IRAs, right? So if you're investing via an IRA or self-directed 401k. So the way the IRS describes it, this income is subject to taxation via UBIT to prevent tax entities from unfairly competing with taxable businesses. And so, I mean, that makes sense, right? You have kind of an untaxed vehicle that is giving you an advantage in the market. And so they charge a fee for any income that you're creating if you're using debt primarily. And so, I have to look, I have to Google again, or you can Google kind of at what rate. Like I said, I'm pretty sure for UBTI, let me see, for UBTI, what is tax rate on income levels? Let's see if I can get this quickly for you. Yeah, so taxable income range, so $0 to $3,100. So if you earn anywhere from $0 to $3,100 of income, and again, this is if the fund incurs UBTI, right? So this is not like this is not just in general, but if there's going to be UBTI and it qualifies for that, then you're at a 10% taxable bracket. And it doesn't take much. Like once you get to over $15,000, it's $3,663 plus 37% of the excess over $15,200 is what you're being taxed at on that income. So, for example, $10,000 in UBTI for an IRA trust, the first $3,100 is taxed at 10%, and the remaining $6,900 at 24%. So, you make 10 grand, but you're paying almost 2 grand in taxes. And so again, like it is significant from an overall return standpoint. And so I think it's definitely something to pay attention to when you're investing in your IRA. Is there UBTI that's going to be incurred on this fund? So far, none. Again, you can incorporate what we call kind of a UBIT blocker, which is not worth going into for this conversation. It's something to ask your sponsors. If there is UBTI, is there any type of blocker in place to prevent that from happening? And in this case, there are no blockers on these funds because we haven't experienced that. There could be a blocker introduced into private credit in future years if we do expect that to be an issue. Okay. Let me see if there's any other questions here. I'm going to come back to some of these specific questions because they're good questions. Okay, let's talk about performance lastly, and then we'll do Q&A because I think this is really important. So private again, this is Aspen income. Okay, and this is private credit. All right. I love that you guys are sticking with me today. Like, again, this is just free flowing. I wanted this just to be highly educational, conversational. And so, this is less of a presentation and more of just kind of hanging out with you this morning. So I hope you're enjoying this and this feels real and feels like we're just kind of sitting together around a round table discussing this, because this is essentially what we do a lot of. So Aspen Income, this again has been in operations over 12 years. It has paid a 9% fixed annualized yield for 40 plus quarters. Never missed. So this is pretty good. This fund, I think to date, I have the partner letter again here, has sent out over 25 million plus of distributions to date. Okay. So really strong performance here for this fund. Again, most of this, because of the consistency of the second lien mortgages, really is the primarily backing of this fund. Although, now we have also 172 of the 783 are also first lien position hard money loans, and those are going well too. So this is 9%. This does, just so we know, in 2026 investors, this actually is going to go to 8.5%. Okay, so if you are considering investing in Aspen Income, I would recommend doing that before the end of the year, because our yield goes from 8.5 or from 9% down to 8.5%. Private credit, again, this has been going on now for 7 quarters. So it's a smaller track record. This is a newer fund that we started to really take advantage of kind of the lending gap and the opportunity in the market today to lend capital at good rates. But, as I share with you, this is a really strong fund. I'll share this tab. And Keith, I see your question about how much is development versus other things. You can see here, 13 million is development. The remaining is recapitalization and purchase. So I'll send everybody a link to the data rooms for these two funds. And this is actually a live dashboard that you have access to via the data room and can look at this. But you can see here, this is the yield of the private credit today. So typically in our private credit fund, when we're giving out placements, we have 4 revenue generators. We have origination fee, which is the fee that we charge to place the loan. And again, all these fees go to the fund. So the weighted origination fee today that we charge to our borrowers is 1.9%. We have a current pay. So this is the pay that is being paid to the fund today on a monthly basis. And that weighted current pay is 5.1%. The accrued pay is the third revenue generator, and that is the interest that is being booked to the loan, meaning it's not being paid out today because the property cannot support it, but it will get paid at some type of liquidity event. So a refinance or an exit, however they plan to take us out, this gets booked to the total size of the loan. So that's at 10.3%, and in most cases, that is compounding. And then the fourth revenue generator is an exit fee. And so that means we charge a fee on the exit of the loan whenever they exit. And so that is at 0.8% today with a total yield of 18.1%. And so that is total revenue or total yield to the fund. So you can see over the last 4 quarters, for our lowest share class, which is Class A at $100,000, it's been right at 10%. Okay, 10% annualized yield. In Q4, again, we've had some really strong quarters. Again, some of these, we just had 25 was a really interesting year. Transaction volume really slowed. And so we really started to see that pick up. I think we have some really strong quarters ahead of us. So Q3 was, I think it was, forgive me, this is in a performance deck. So this is not exact, but it was right close to 11%. Q4, we're on target to be above 12% for Class A investors for this fund. And so this pays a 6% pref plus, and this pays it monthly. Okay. And then plus a quarterly profit share, which is why this can fluctuate a little bit because of the profit. And so this is where this blends out to anywhere between a 10 to 13% annualized return. Okay. And again, both of these funds have never missed a distribution. And this is a 1-year lockup. This is a 2-year lockup. Both have quarterly redemptions after that, meaning at the end of 2 years, or at the end of 1 year and the end of 2 years, we ask for, you can redeem at any quarter and give us a 90-day notice. Now, here's the big thing I want to talk about, because I think this is really important. all right, is especially in today's environment where everyone's chasing the highest amount of money, regardless of the risk, is I want to talk about compounding interest before we wrap up here and go to questions, because I think this is so significant. I'm going to just use a simple example. I think most folks who are accredited have the ability. I mean, this is a doctor, Bob wrote a book. If you haven't read Bob and Ben's book, Invest Like a Billionaire, I would highly recommend this book. It is the ultimate guide for alternative asset investing. It is a phenomenal guide for you as you are looking to diversify your portfolio. It's based on a study from David Swinson, the Yale endowment, and how he was able to beat the market for close to 40 years using alternative assets, and essentially change the 60-40 model today. I mean, I just went to like I said, this capital allocator conference, and it's more of like a 60-20-20 model now. And so anyways, great book and helpful for the retail investor as well. But one of the things I want to share is the power of compounding interest. So, and just see the difference here. And I think both of these are great funds, and we can talk about how they work together. But I do want to show, like, if you were able to invest $80,000, so $80,000 per year, and you did that for your entire career. Okay. So you said, hey, I'm just going to put $80,000 a year every year for my career, and I'm going to get 9% compounded interest. And in both of these funds, you can reinvest your distribution, so you can actually compound the growth in these assets. Now, this is not including taxes you pay, but go with me here, okay? So 9% compounded interest over 40 years. Anybody want to take a guess without looking at a calculator over the course of 40 years at 9%, how much this is worth? Any guesses in the chat? Oh, shoot. Sorry, guys. I realize you're seeing nothing. So I'm sorry. So this is right here. My bad. I need to turn on like audio so you can see this. So performance Aspen. Sorry, I typed all this out. I was just talking, and now you can see it. So I hope this all makes sense. 12 years going on, 9% fixed annualized. Private credit has been going for 7 quarters. Class A, this was the last trailing 4 quarters yield. Q3 was 11. Q4 is expected to be over 12%. Okay. So anyway, so let's dive in here. 80,000 per year for 40 careers. That's a long time. For 40 years. 9% compounded interest. What do you end up with? Any guesses? It's a lot. Someone said 3 mil. I don't think you understand compounding interest. No offense. $27 million. 1, 2, 3, 1, 2, 3. Okay. It is a lot of money. This is a lot. This is significant. This is why this is the power of compounding interest. It is not about how much you make. It's about how much you make for the longest amount of time without experiencing drawdowns. And so this is the power of alternative investments, right? As it allows you to diversify capital and reduce. Here's the thing, guys. If you're in investing long enough, even in real estate, even Aspen or any good sponsor, if you're in this business long enough, you're going to have drawdowns. Why? Because no one can predict the future. Everyone makes, you could call it mistakes, or gets caught up in a bad market or a downturn or whatever. And so it's just like golf. If you're a golfer, you're never going to hit the perfect swing every time. The best golfers, you know what they do? They reduce the amount of error in their swing. And so it's not about hitting the perfect shot every time. It's how do I reduce the amount of difference or error in my swing to hit consistent time over time. And investing is the same way. You're not going to make perfect investments for 40 years. So you need to find ways to diversify your investments in order to reduce the volatility in your portfolio so that you can take advantage of compounding interest, because losses are worse they hurt a portfolio than gains help it in most cases. Okay. And so you can see why compounding interest is so significant. So at 9% is 27 million. But let's just say you were able, and you're on this webinar today, and you say, well, Ellis, Aspen income is pretty strong. 12 years, 9% fixed annualized. That's pretty good. Even 8.5 is not bad. But again, so why introduce slightly more risk for a slightly higher return. Maybe you shouldn't. Okay. I'm not saying you should, but if time is on your side and you're willing to diversify a little bit, this is again, there's always, you have to associate risk with return. So in private credit, is there a little more risk in this fund? Absolutely. Why? It's smaller in terms of size. It's smaller in terms of placements. You're talking about almost 1,000 loans versus 13 in private credit. But again, this is also where we're able to generate, close to 13% on a compounding basis return. Let me ask you this. What do you think the difference is? If 9% is 27 million, how much is 12%? Same scenario. So 12% compounded interest for, $80K a year for 40 years. Let's just say you did this. You might know what this is. It's $61 million. That's 34 million more by just increasing 300 basis points or 3%. It's pretty significant. So as an investor, yes, yield really matters. The better question to ask, though, in a case like this or with anything, yes, we're all chasing yield. We want to get alpha, which is, just return above the market. The better question to be asking, though, is how much more risk do I have to take in order to go generate that higher return? Because it is a significant difference over a long enough period of time if you're able to compound. And so, again, this is why we really like both of these funds. We think they, in someone who is looking for income, you could be in both of these. I would say, both of these funds are great for someone who wants to have kind of a foundation to their alternative asset, portfolio. We also have a lot of kind of retirees who are in both of these funds, and again, because the lockup is much less. I think it's also one of those things, as I'm speaking with investors, is, going back to this right here, if you're going to be in a common equity position, you really have to consider is, if I'm going to go in a development deal where there's no cash flow today and I'm taking all of the development risk, take, for example, we have an industrial growth fund, like use our own funds as an example. We have an industrial growth fund and it is as a development play. And, as an investor, you have to ask the question, is the trade-off worth it? Right? Meaning, and so, for example, if we were doing the industrial growth fund and we were promising a 12% annualized return, do you think many people should take that? No. Why? Because it's not worth it when we can go get 12% today in private credit and you're not waiting 5 years to go get 12%. You're getting it in the year that you invest. Why would you go take the development risk? So, for us, we're really targeting a 2 to 3x return over a 4 to 5 year period in our industrial growth fund. That's about 20 to 25%, right? That's pretty significant difference. And so for kind of long-term investors, they may be willing to make that trade. So I think it's one of those things you have to benchmark when you're deciding where you're going to invest in the capital stack. Is the risk that's being introduced to go get the higher yield, is it really worth it? And can I get that same return somewhere else and invest lower in the capital stack? And those are two really great questions to be asking as you're evaluating investments. Okay. All right, guys, I want to just take some questions and I hope this was helpful. Sorry that I wasn't sharing my screen earlier, but if I need to kind of dive into this, I'm looking at the screen now. So I should have had both of those pulled up. Are you compounding monthly or quarterly? Chris asks. Chris, I think you're asking in terms of I kind of talked about two different things. So from a lender standpoint, it really is kind of based on the operating agreement. So some were compounding monthly, some were compounding on an annual basis. From an investor standpoint, you're compounding on an annual basis here. Okay. You're compounding on an annual basis. All right. What else? What other questions are there? Yes, we will definitely send you a link. I will also send you both. We have data rooms. Again, guys, if you have any questions about this, you want to invest in any of these funds, you want to speak with us, with our team, our investor relations team, just send us an email, investorrelations@aspenfunds.us. Okay, but I'll send you a link to this as well, and you can reply directly back to that. Why is one fund a minimum of $50,000 and the other $100,000? Good question. To be honest with you, we really don't accept $50,000 into really any vehicles anymore. Aspen Income is kind of a legacy fund, and so that was just built into the fund previously. And so most of our minimums today start at 100, potentially even, some funds even $150,000. The reality is we don't have a very large team, and we'll raise about $150 million of equity this year. And so part of it is, we really can't serve everyone is the reality. So we have kind of higher minimums for really that purpose, and want to make sure we're aligned with the right partners who kind of have a long-term vision of what they're doing. And so 100K is typically the minimum in most investments. Why is the interest rate lowering on AI? It's a good question. It's probably a better question for Ben to answer on this. I think part of it is, again, you've seen that, over time we've introduced more hard money loans into that portfolio. And so we just want to make sure that we're over the long term able to continue to, pay the dividend. And as that, as rates are going to come down, it's more competitive out there. And so it's part of just being able to compete and be able to offer money is part of why. I mean, that's kind of the nature of anything, right? As more capital comes into the market, yield gets compressed. And so that's probably one of the main reasons. Maybe Ben can add some color to that, but to my understanding, that is the main reason. Yes. So is the 2% AUM fee factored into the results you shared? Yes. Everything I shared in terms of yield to investors is net of all fees of Aspen. How long will the Aspen Income Fund remain at 9%? Till December 31st. So if you invest in the new year, then it will go to 8.5%. It is the plan as of right now. And so again, we ask, and I don't mean to sound rude, or maybe I do mean to sound direct. Please do not wait until the 29th to submit your commitment in anything that we do here in Aspen, because you probably won't get in. This is a very busy month as investors are looking to get into funds. And so we just kindly ask, because we want to be able to make sure we get everybody in, that you make any commitments, prior to Christmas, so that we have kind of post-Christmas to process everything. So Dustin asks, is it possible to do a hybrid approach with the private debt fund? Example, take the preferred 6% cash on cash return as a distribution and reinvest, compound the profit share. No, Dustin, it's not. However, what you could do is you could have two different placements. So let's say you were investing $100,000, or more. What we could do is essentially separate that as two placements, right? And so if you wanted to take distribution from one of your, from a partial amount of your money, but then compound the other part, you could do that and kind of blend out the same thing based on kind of, just work it out in terms of the math of what you want to actually pay back to yourself. And we could do it that way. So there's no really way to break up the compound or the pref versus profit, but we could break up the placement for you, and we'd be willing to do that. Are you guys currently investing in private commercial deals in KC? Let's see. So if we go back here, share this tab instead, you can see that we have a couple deals in this area. So this is a deal right here in Kansas City. This is actually Lee Summit. This is a multifamily deal we did in Lee Summit. Down here in Springfield was another deal that we did. So those are the only two deals right now inside of KC. We are looking at some other deals right now that are in this area, as our reputation is just growing among colleagues and brokers, et cetera. But we, a lot of this is in the Midwest. You can see kind of a strong concentration here in the Midwest. But these are the deals that are happening. $1.5 million. This is a multifamily deal. Let's see, what was this? This was also a multifamily deal. This is a cool dashboard. This will be in our data room for private credit. You can click on this and kind of see the details of all this. This is a multifamily deal, development loan, $3.3 million. All right. Did I miss anything? If I missed a question, would you please drop it again? Because I'm not able to. Let's see. Share screen. Sorry. Yeah, this is what I was talking about. So you can see here where our deals are at. So this is the dashboard. So again, these are the deals that are concentrated here in the Midwest. So Kansas City, Lee Summit, Springfield, Ozark area, Bentonville, Arkansas, Oklahoma, and over here in Colorado. And what's cool about this dashboard, if you dive into the deal room, you can kind of click on these and you can see, okay, this is a multifamily deal, this is development, and then you can actually see all of the terms of that deal here. So it's a very interactive. This is the deal. Someone asked about Kansas City. So this is multifamily. This was for a purchase. This was the term of that loan. So if you go into the private credit deal room, you can actually find this dashboard and look at all of this, which is really cool. Are you lowering the pref in 26 on the private credit? No, that is staying the same. So for Class A investors, we have Class A at $100,000. We have Class B at $1 million, and then Class C is at $5 million. And so 6%, 7%, 8% pref on those funds. Okay. Let's remove this for now. If you invest in 2025, will you still receive the 9% pref return in 26? Yes, you will. So if you invest in 25 into Aspen Income and receive the 9% dividend, that will stay for now for the foreseeable future, definitely through 2026. That will not get lowered to 8.5%. Okay. It's only if you invest in 26 or any new investments that you make in 2026 will be at the 8.5% and will not go up to 9%. What are your requirements for lending on private credit? Do you need second position liens? So I think what you mean from a borrowing standpoint, what are we really looking for? We do not need to be in second lien position. In fact, most of our pref equity positions we do not have a lien on the property. And so you don't in a pref equity deal, right? And so what we typically require is that there isn't some type of second lien, meaning there's the senior and then there's us. So there's no one in between. We don't allow that. There can be no one outside the senior lower than us in the capital stack. We also require either or both drag to market rights, meaning we can force a sale, or we can take over and or replace the manager, right? Don't you love Apple? You guys, did you know if you do 2 thumbs up, you get like fireworks. So like, that's kind of cool. Anyways, so that's what we require in our pref equity placements is, sorry, I got really distracted by the balloons and the fireworks, but we require either the ability to drag to market or take over, but we don't require second lien. It's nice. We definitely try to get second lien, but not always the case. And again, sometimes, most of the portfolio is pref, and it's from a tax standpoint, it's more efficient that way for investors. You require a minimum $100,000. Do I understand that one can put $50K in the debt and $50K in the credit funds? No, that's if you're going to invest in private credit, it needs to be, if you're a new investor in private credit, you need to start at $100,000. Now you can add more shares later for less, But if you're going to be into private credit, it starts at $100,000 minimum, and the debt fund or Aspen Income starts at $50,000 for that. Okay. Yeah, Lawrence asked, can you please repeat what you mentioned on depreciation? Let me just do this real quick for you so you can see and make sure I'm sharing this correctly for you. So let's go down here to the tax standpoint. So, and just kind of recap what we talked about. So for Aspen Income, you can see that, again, both of these, so taxed at kind of earned interest income, your effective tax rate. This APCF is rental income because of the pref equity, and that's also taxed at your effective tax rate. There is no depreciation pass through on Aspen Income. However, it is a K1 investment, so the income is treated passively. And if you have other depreciation, you can use depreciation to offset the income from Aspen Income. In private credit, we do pass through depreciation from the pref equity positions. We are getting depreciation from the sponsor or from, because we're an equity position in the deal. And so in 2024, for example, we had a 20% actually loss from the K1. We made over 10%. The investor made a 10% annualized yield, or more than that, 10.5, but showed a 20% loss on principal. In 25, it's expected to probably be more like net zero, meaning there's not going to be any type of outsized loss on the K1 for 2025. In 2026, imagine it will be somewhere similar. This is not a fund where you should invest to expect outsized losses like you would a single asset multifamily deal where you're getting a large amount of depreciation passed through. But again, it's efficient is the best way to think about it. And so you are getting really tax efficient income from this, from private credit. What are your total charges for lending on private credit? Yeah, I mean, I'm not going to jump into that a whole lot. We'll show you this just because you're asking. Share this tab instead. Make sure it's showing with you. But you can see just from an overall standpoint, and maybe you're a sponsor, this is on average right now. It's about a 15 to 16% total. And again, this just depends on the, what we're lending to. But we typically have some type of origination fee, some type of current and weighted accrual, and then an exit fee. So total yield today is about 18% for all of our placements across our fund. And again, this is going to vary depending on what the placement is. If it's development, which we're not doing a lot more development right now, we're feel good about our allocation to that. That's going to be higher, of course, versus maybe a purchase or recapitalization placement for a stabilized multifamily deal. Yeah, which of these two funds would offer more benefit for an IRA investor? My great question. Again, because you're an IRA investor, you're not really able to take advantage much of the tax benefits. Neither of them do I have concern at the moment for UBTI. And so it really is, from an overall, like how much you're looking to allocate. I mean, for me right now, I think private credit is one of the best risk-adjusted places to get outsized yield today, right? We have several really strong quarters ahead of us. Our portfolio is in great standing. And so, if you're able to generate another 3.5% yield by taking a little bit more risk, I like private credit today. But if you're someone who says, hey, I really don't, that difference is not meaningful for me right now, or I don't really have the time for that to compound significantly, then, maybe Aspen Income is better for you. And you're just looking for, something that is fixed, stable, and that could also be a good one. But for me personally, and this is not giving advice, this is just telling you where I'm at in my stage and what I know about our funds is I think it's in the market today for the risk that you're taking in private credit, and it's specifically our private credit fund. It's really, really hard to beat the overall return that we're generating in that fund today, based on the amount of risk that we're taking. So I hope that's helpful. Okay, guys, we are right at an hour, so I am going to wrap this up. Thanks for hanging with me today. I really enjoyed it. We'll hope to do more of this. If you enjoyed this fund, we'll make sure we get a replay link out to you along with both of the data rooms. Again, if you have any questions, you're interested in these funds, please email us, investorrelations@aspenfunds.us. And the nice thing about investing with us, any investor who invests with Aspen, you get a direct contact. So you have a direct contact with Aspen that you can ask any of your questions to. And then you also have the support of our entire investor relations team. And so we have a whole concierge team that can answer your questions. And so when you invest with us, you will be assigned a direct contact who you typically have their phone number, they have your phone number, and anything you need over the process of investing with us, you know who to reach out to. But also at any time you can reach out to us via email or call us, and you have the support of our entire team. We really are, we really try and provide a white glove service for our investors, and really want to make this really accessible for accredited investors, and hope to create a great experience for you. So thanks everyone. Have a great week. Talk soon. Cheers.